CFDs, or contracts for difference. What are they? How do they work? Should you trade them? Let's break it down in this video. Before we do, I have a message from today's video sponsor, XTB Trading.
XTB are an online trading platform who are running a free investing masterclass, which I think many of you will find value in. They are going to be discussing everything from putting together a stock portfolio to assessing the risk of inflation, geopolitical tensions on market volatility, and how oil and gold prices are affected during these challenging times, along with much more. So if you want to learn more about navigating the current market successfully and learn how to build your 2022 portfolio from speakers such as Jamie Rogozinski from WallStreetBets, be sure to click the link in the description below to secure your spot for the event, which takes place on the 19th of March at 10 AM BST. Further details can be found in the description box below.
So, CFDs. Now this might get a little confusing at first, but bear with me. Once I've explained how they work, I will run through an example and I promise it will make much more sense. So a CFD, or contract for difference, is essentially an agreement between two parties to pay the difference between the opening price and closing price of a trade. Obviously, in our case, this agreement is usually between a retail trader, us, and a brokerage. The opening price would be the price that we open our trade at, and the closing price would be the price that we close our trade at. The party that pays the difference depends on whether we got the trade direction correct. If we bought a market and then closed it at a higher price, the brokerage would pay us the difference, the profit. However, if we closed it at a lower price, we would pay the difference from our trading account. This would be a loss. CFDs are very useful for retail traders like us for a number of reasons. The first is that CFDs are what's called a derivative. A derivative market derives its value from an underlying asset or index, like gold or the S&P 500. So if the price of gold goes up, for example, so will the derivative market. This is useful for retail traders like us because it allows us to trade the gold market price movements without ever actually having to take stock of any gold. Essentially, we can just speculate on what the price will do without having to own the underlying asset by trading CFDs. This includes enabling us to profit from any falls in price as well as any increases in a market's price. This is known as short selling, or going short. Secondly, CFDs give us access to leverage. Essentially, leverage is the ability to use borrowed funds to trade larger position sizes than the account would ordinarily allow by only putting down a margin deposit. Again, I know this will likely be confusing, but stick with me, it will make sense shortly. When looking at CFD derivative markets, the margin requirement should be stated. If the gold market requires a 2% margin, then we would only need to put up 2% of the total position value. This would equate to leverage of 50 to 1, because the total position value will be 50 times the margin deposit we are required to pay. As a side note, I see a lot of scaremongering online about leverage, and I don't totally agree with everything that gets said. I'll be making a video about leverage in the near future, so subscribe to the channel and hit the notification bell to be notified when this video is uploaded if you want to see more. Cheers! Okay, let's look at an actual example, and then this should help this information make more sense.
Let's say we wanted to buy some shares in company X as we think the price is going to go up. The share price is $10 and we want to buy 100 shares. If we were to buy 100 shares normally, this would cost us $1,000. However, the CFD market that follows the price of company X's share price has a margin requirement of 5%, meaning to buy 100 CFDs of the derivative market to get the same exposure to company X's share price through a CFD position, we would only require a margin deposit of $50. This means that we would still make and lose the same amount of money as the share price moves as we would if we had bought 100 shares for $1,000. Except this position has only cost us $50 to open, not $1,000. Now let's say the share price of company X drops to $9, and because we have exposure to 100 shares, this means our trade is down $100. So we decide to close the position and cut our losses. This means that the difference between the opening position and the closing position is $1 times 100 shares, which equals $100. So us, the retail trader, owed the broker $100. So the total loss on this trade is $100. You don't lose your margin deposit on top of the trade loss. But how was that any better than simply buying the shares normally and selling them again? Well, to do that, we would have needed $1,000. To do this trade, we only needed $50 to open the trade for the margin deposit. So even if we only had $200 in our account, we could have still opened a trade that had the same exposure as if we'd bought 100 shares that cost $1,000. Now let's instead say that the price went up to $12 and we close the trade. This would mean the broker owes us $200, as the difference between the opening price and the closing price is $2 times 100 shares, which equals $200. So from a position that cost us $50 to open, we would have made a gain of $200. That's a 400% gain. This is the power of leverage, and CFDs are one product that give retail traders access to this.
Now, obviously, with the benefit of increased buying power, not only are your wins increased, but so are your losses. Trading with too much leverage makes it very easy to blow an account very quickly. That's why it's very important a trader understands what they are doing and the risks they are taking when it comes to leverage. Understanding how the position sizing works when trading CFDs is relatively straightforward. If you are trading stocks, for example, one CFD will be worth one share. If you're trading Forex, one CFD will usually be the same as one lot, and so on. If you are ever unsure, the broker you are using will be able to clarify this for you. And that wraps up this video, traders. I really hope you found this information digestible. Let me know what you think, and if you've got any questions in the comments